Everybody for sticking through another session. I did want to give you an overview again. Our first presenters, I'll say, spoke at the higher level, more of a macro look per se. Our middle group is, I hope you got a great experience there. It's a roll-up story that's, I would say, you could ask 50 more questions afterward on. I got my one in, many more to go. And now we have our Dealmaker panel. And I think our Dealmaker panel is going to focus more, I would call, regional to local marketplace, right? We want to find out really, truly what's going on here in our marketplace. So I'm not going to do a lot of introductions. I'm going to let everybody introduce themselves. I thank them very much. They've been very cooperative and helpful in putting together this section. Thanks.
Well, hello everyone. I'm Sima Griffith. I'm a co-founder of Aethlon Capital. We're a boutique investment bank, and we sell privately held companies that have between 20 million and 200 million in revenues. We focus on 4 industries: manufacturing, technology, consumer, and transportation and logistics. And I'm delighted to be here. On the personal front, I come from a family of entrepreneurs. My father bought businesses. He bought a tennis club, not knowing the first thing about how to run it. He gave the keys to my brother and I when we were in high school and college. And that's how I ended up in finance. It was the guys at the tennis club who said, go to Wall Street. That's where the action is. So here I am.
Good morning. Can you hear me okay?
Mm-hmm.
Yes. All right, great. So my name is Kielhorn. I'm a principal at Tonka Equity Partners. We are a private equity group based here in Minnetonka, Minnesota, and we just celebrated our 25th year of being in business, which we're proud of. So our focus is to be the first institutional capital in founder or entrepreneur-owned businesses. So these are companies that are revenue-wise, they're about 10 million up to 50 million, and EBITDA is 2 to 7. So these are lower middle market companies. They're not startups, they're not troubled assets, but they're companies that have kind of reached an inflection point where to get to that next level, to grow from 20 million to 40 million of revenue, they just need some professionalization, they need more resources, and that's where we come into play. So we're buying more than 50% of the company, but less than 100%. I know we'll talk about terms and structure later today. So we're doing buyouts. We're providing those founders an opportunity to monetize what they've built, take some chips off the table, but they still participate in the next phase of growth. It's the second bite of the apple. We have a lot of really good stories about where the second bite of the apple, that 20% rollover can be worth just as much or more what they sold the first time. And if that happens, everybody's really happy. So industry-wise, we're generalists. We invest in kind of 3 broad categories: highly engineered manufacturing, business services, and value-added distribution. We invest all over the country, but a lot of our businesses are right here in the Midwest. That's where I think our cultural fit can be a differentiator, so we love to invest here in Minnesota and in the Midwest. Personally, I've been at Tonka Bay for 8 years now. Prior to that, I was with an accounting firm called Ernst & Young. From Iowa originally. I moved up further north, which I didn't think I'd ever do, with my wife 10 years ago. We have a 6-year-old little boy and a 3-year-old little girl, so that's what keeps me busy outside of the deal world.
Can you hear me? There we go. Is that better? We're going to share. That's okay. All right. Thanks for having me. It's exciting to be here and nice to meet all of you. My name is Emma Gergen. I work with Carlson Private Capital Partners. We are only 5 years old. I can't wait until we're 25 years old. But we were formed 5 years ago from the capital from the Carlson family. And as many of you may know, the Carlson family started their wealth in the 1930s with the first loyalty program for grocery retailers called Gold Bond Stamps. They parlayed that success into owning a number of businesses over time. Most notably, they owned and divested of Radisson Hotels and TGI Fridays, both that invested since the early days. It's that capital that the family decided to set aside about 10 years ago with the idea that they could create a solution for founder and family business owners that could be differentiated from the current private equity capital out there today and have all the benefits of a private equity model, but without a lot of the drawbacks around hold period and the fiduciary responsibility that a single family capital base has to its employees and its communities that's just inherently differentiated relative to the fiduciary responsibility that an institutionally backed private equity firm would have to its investors. And so our firm seeks to invest $20 to $100 million of equity capital into family and founder-owned businesses where the selling founders can have an appreciation for that type of mentality and the legacy that we can help continue on with the businesses, its employees, and communities through our investment. We have 6 investments to date, and it's a variety of industries, and all of them have a founder flavor, as I described. Personally, I grew up here in the Twin Cities. I also come from a family business that my great-grandfather started in 1919, and I now own with 130 of my closest cousins. So my personal experience is growing up with that family business, and then my professional background, which is most recently at Norwest Equity Partners, was a really great combination for this platform for the Carlson family. I have 2 kids, a 4-year-old boy and a 2-year-old girl, and in addition to that, I serve on the board of Krier Jesuit High School, which is a local nonprofit high school that sponsors low-income students through a corporate work-study partnership that would be welcome to engage with any of you. Thanks for your time.
Very good, thank you. We've all had our experiences with the, hot, maybe warm 22 market, and now we're experiencing 2023. I'm curious to know what maybe has caused, the cooling of the market here more locally, regionally. Emma, you want to start?
What are you saying? What's caused the cooling?
What's caused
of the
kind of
market?
the cooling here, more regional?
Yeah. So what we're seeing is a pretty trepidatious impact of the regional banking and the broader banking and financing markets. I think there was at least relative to maybe 6 months ago, there's a little bit more activity that's starting to come back. But because the financing markets have been so choppy over the past few months, it's definitely more difficult to get a deal done. And so everything is taking longer. I guess I wouldn't say that it's to a halt at all. From my perspective, there's still a lot of deal activity, but the price of money is obviously at a different point than where it has been historically, and so valuations are seeing an impact from that, and there's just a little bit more trepidation in terms of where the gap exists between a seller's expectations and what a buyer is willing to pay as a result of the challenges in the financing markets.
Yeah, I'd just like to piggyback off of what you said, and I think what's really changed are interest rates. So if you rewind back to March of 2020, interest rates were 0.25%. Fast forward to today, and interest rates, the Fed funds rate is between 5 and 5.25. And so those higher interest rates and the higher cost of capital is really causing a downturn. The downturn isn't significant. PitchBook just put out a study that said the number of deals in Q1 of 2023 are down 23% versus Q1 of 2022. So it's somewhat of a slowdown.
I think a lot of it is relative also. I mean, we're coming off of like the 2 greatest years of M&A activity valuations ever. So if you look at this over a longer time frame, 2023 is still good. I don't think things are as bad as what the news cycle would lead you to believe. I mean, companies performed really, really well in 21 and 22 for a couple of reasons that we can talk about. Companies performing well lead to higher valuations, more M&A activity, pretty simple drivers. They could raise prices as frequently as they wanted the last couple of years because consumers were scared, end users were scared they couldn't get it. And so all of our companies, I'm sure you guys did the same at Carlson, you could raise prices 15% and you couldn't keep up with the demand. That's a great position to be in, and the value of your company is going to increase as your EBITDA, your margins all increase. That's unwinding now. People bought a lot of inventory over the last couple of years because it took 6 months to get it, 9 months to get it. And now that their demand has slowed down, they're selling less, they have shelves that are stocked. And so their demand is less, they're buying less. So as much as things accelerated over the last 24 months, it kind of cuts both ways. And so I don't know what the right term of it is. Like COVID recovery was 21, 22. We're in like this hangover or whatever comes after a recovery time frame. Companies performed really well in 22, which is why I think valuations and the activity was so strong. they're just not performing as well this year. It's still not a bad year. That's not a great headline for the news cycles to say things are fine. It's not great. It's not terrible. But I think things are it's just fine. It's not as good as what it was last year.
And another reason they're not performing as well, I hear this from our manufacturing clients, Cam, is their labor costs are up. And so that's cutting into their profit margins.
Just one more dynamic that's going on as it relates to the statistic that you brought up, Sima. I think if we were to bifurcate that between larger deals and smaller deals, you'd actually see that sub 150 million, the activity has continued, and it's really over 150 where there's been more significant drop off because a trickle down from the syndicated loan markets being closed to very difficult to navigate. Would you agree?
Good point.
Yeah, no, I believe that's true. What we're seeing in the small business, lower middle market space, it has not let up. It's going full force. Let's talk about the length of the deal process. As you know, 23 has now hit us in different ways, but I think we can talk about what the deal process and looked like a couple of years ago. We heard it was fast. We heard due diligence was quick, and a lot of different legal restrictions were dropped in agreements. I do think it's changed. Go ahead if anybody has comment.
Yeah, it was a good time to be a seller in 21 and 22. I mean, it's kind of like selling your house. I have friends ask me what I do, and I try to explain. It's a lot like the housing market. 2 years ago, you could sell your house and you could just throw out a big number, and people were waiving, doing an inspection on a 100-year-old home in Edina. And you would really scratch your head at that. And so you just add a couple more zeros onto that, and that was an M&A environment last year or 2 years ago. A lot of times in our industry, we differentiate on price and on culture. Speed became a way to differentiate over the last couple of years, and so people would come to the LOI stage when you're selling a business and say, I'm done with my due diligence. We did a light touch on Q of E. The environmental is clean, legal looks clean. We can close in 2 weeks. And we're paying a fair valuation. Now, because the competitive dynamics are not that, it's a 45-day exclusivity period. I think terms are just kind of swinging back to more normal market dynamics that you're probably seeing all the time. It was fast and furious for a couple of years, and you probably saw some stuff that maybe you don't normally see in a regular market.
Yeah, I can get really specific about this. Because there's more uncertainty in the market, maybe there's a recession looming Q4 23, Q1 of 24, and the buyers perceive more risk, they're doing more due diligence. And an example is our client who's selling their manufacturing business. The buyer hired an outside accounting firm to do a Q of E. The accounting firm sent my client 8 pages of questions. And in addition to the 8 pages of questions, they wanted to see every adjustment to EBITDA, entry into the general ledger. They wanted to see every invoice for the add backs to EBITDA. So that extended our closing by 60 days.
Yeah.
On top of that, you have in the last 5 years, rep and warranty insurance has become more prevalent. And then the insurer needs to do their own due diligence. Has the company paid all the sales tax? Are there any lawsuits? Are there any HR issues with employees? You have the Q of E due diligence. You have the rep and warranty insurance. And then you have the lawyers trying to show how smart they are and document every possible risk. So I'd say that's added 60, 90 days to closing.
As a plus side, because it's not all negative, it does allow for a lot better evaluation of the cultural fit between the buyer and seller, which I think Cam and I probably agree on this point that it's a good thing for us because we like to differentiate on that and can establish a really good partnership with the seller as we're going through the diligence process, and then they get that much more confident in the partner that they're selecting. And from a seller's perspective, because there's this expectation that it's going to be a longer period of time, they can use that to their advantage in vetting the relationship and fit with various parties, as opposed to the prior guidance from a process perspective, which was just to get the highest price, you had to move fast with perhaps ignoring some of the other kind of qualitative factors around the deal.
Cam, any comments there about the same as Emma?
Yeah, I mean, I think that's right. We like having a little bit more time, having 90 days to close. I mean, you're right. It's the cultural fit. Even if you get something signed up under exclusivity for an LOI, having 90 days to figure out who you're going to be partnering with for the next 5 years for us and longer for you, that's really important time that you want to get to know the people, to make sure you're in alignment with your values, your goals, your objectives. And so 2 years ago, that time would go by really quickly because you're doing due diligence and you only had 30 days to do it. And so there wasn't a lot of time to go out for dinner after a management meeting. It was, I'm going to go home and work on these 8 pages of questions that you have. And so time is everyone's friend a little bit when you're trying to develop that rapport.
Well, we have a saying, time is not your friend in the deal business. And the buyer is going to take as much time as he or she can to watch you. Yeah.
That's why we have different perspectives on the panel. I'm going to segue a little bit and keep on due diligence for 1 second, because Joel's group here, they brought up customer surveys and supplier surveys. Do you see that happening with your groups as you do due diligence?
Yeah, that's a key part of our due diligence, is talking to the customers, and it's not through the lens of we're doing a deal. What can you tell us? It's more of a net promoter score, and to hear from them, what did this company do well? What do they not do well? What would you buy more of? What would you maybe buy less of? And so, the company finds that very valuable too, because they're getting a free NPS score out of it, which is should be something they're thinking about. So that's a key part of our due diligence, and we understand that nobody's perfect. You're not getting an NPS score of 10. There's going to be customers that say, well, these guys can do something better. I guess we're optimists as investors, and we think, okay, well, there's opportunity here. Maybe we can sell more to them. Maybe they're buying something from a competitor. We can get more wallet share. Or just, hey, here's something we should focus on in the first 90 days to improve customer service or lead times. It gives you a very good insight into what an objective user of the product is really thinking.
I agree with Cam. My only addition would be just a suggestion that if you're going through this process, that if the buyer allows you to have input into the questions, you can get that much more out of the results. Because we try to the extent possible in the process, bring the sellers to the table when we're designing the questions so that we can create as much value post-close with the answers that we get as possible, both on the supplier side and the customer side. So you'll find that you can really validate some of the value creation initiatives that you had kind of assessed on the front end if you're able to ask the questions in the right way of the customers when you're doing those surveys.
So I would agree, you can get great market intel from the market research. The issue that comes up is confidentiality. And a lot of our clients don't want their employees to know that they're for sale because they don't want their competitors to pounce on their employees and try and steal them away. So in a recent market study, we thought, well, all the account executives who are in charge of these customers don't know about the sale. So we don't want to start this market study until we know we have a deal, and then we'll bring our salespeople under the tent, but make sure they don't tell anybody. So it's complicated. The market study is complicated, and you want to wait till you're like 30 days before closing.
I think that's what we heard too.
Yeah.
Do you go confidential on your customer surveys, so you don't talk about that you're a potential acquirer, right?
We'll use a third party typically to do it, and it's all under the guise of being a customer survey on behalf of the target.
Yeah, a lot of these companies that do the market surveys, they have a company website. I mean, it's very legitimate. So I'm Cam calling from Tonka Bay. First thing you're going to do is go look at this website and say, okay, they're a real company. People like to share their insights and their opinions of a supplier, so you usually get good information, but it's not, we're doing a transaction. It's, we want to know how we can serve you better.
But as our client said, if someone calls up their customers, the first thing the customer is going to do is call their account rep and say, hey, you've commissioned this market study, what's going on? So that's the issue. It's very
It's gotta
tricky.
it's got to be handled appropriately.
Well, I can be known for going off script, so we're moving around pretty good. And we didn't have much of a script. Part of it is because we like to go off script. Sima's been with me how many years? About 4 or 5 years now doing this?
Well, yeah, we've done this panel a long time, but I've known Jay for 25 years when he was making acquisitions for the Dolan media empire. So we've got a long history.
Oh, that's true. That's true. We looked at a few of your deals. Let's stay with deal structures. We've just come off due diligence. As we look at current deals compared to maybe a year ago, are there changes in deal structures and more emphasis or less on earnouts? What can we say about deal structures?
Let me start.
Yeah.
I'll start with just a couple points. We're seeing a definitely some more openness to earnouts, especially because of the dynamic Cam described with, as I'm sure you guys are all seeing in the businesses that you work with. There's just been a lot of noise in the financials as a result of perhaps some, just the challenges in the supply chain and the openness of the, starting with the customer, the spending that was happening very, very aggressively. That's now not. And so it's really hard to parse out the numbers from a diligence perspective. And so we're definitely seeing some more openness to earnouts or structure. We're also seeing over-equitizing. We're over-equitizing our deals probably even more so than we were before. As a family office, we take a different perspective from a risk relative to how much leverage we may put on the business compared to maybe when my former life in the traditional private equity market, and where we were maybe a quarter of a turn below market. Now we're probably a half or below, and the market's also, putting less leverage on deals to begin with. So we're seeing a larger portion of the purchase price being in the form of our equity.
Yeah, a couple things I'll add. Yeah, we're doing the same thing. We're using less debt, A, because it's really expensive, and B, because there's a little bit less confidence in what the next 12 to 24 months is going to look like, so you just want to take a cautious approach and use more equity and less debt. Earnouts, no one loves earnouts really on either side, but they're a tool to be used. I think the reason they're becoming more prevalent now is for 2 reasons. One, again, I use the house analogy a lot. If last year you look back and you said, well, I think I could have sold my company for $100 million and now it's probably worth 80, it's really hard to move past what you could have, should have. Time means everything. So you'll never forget about that, and you have that in your head, so you're trying to bridge that gap. The other thing is just the trends of the last 36 months are very difficult to make heads or tails of because of what we talked about earlier. The price volume analysis we all do when we're investing in these companies was unusually aggressive in 21 and 22 because both pricing and volume went up at unprecedented levels. And so in 22, 23, those kind of swung back down. And so to try to understand what that looks like for the next 12 to 24 months is a great tool to use an earnout to say, well, if we get back to certain levels, we agree that the valuation can be achieved, but we have to wait and see that out.
Yeah, I was just going to ask real quick, so more equity, less debt, what's that doing to the mezz market? Are you decreasing your mezz, decreasing the secured, kind of all of the above? What does that look like?
I think we all have kind of unique structures in which we can use, from what I've seen, and you guys can chime in as well. I think mezz has become a more popular option in the last 12 months because the unitranche, non-bank lenders are always more expensive than the U.S. banks of the world, and now they've become about the same as a mezz rate. So while their amortization is lower than a traditional regulated bank, usually your amortization on mezz is 0. So the cost of capital makes it very attractive. And a lot of times the mezz groups, there's a lot of great ones here in town, they all have kind of an equity orientation or a flavor that they understand. They don't look at it purely as a bank. They look at it as both debt and equity. And so I think they've become a more popular option as rates have gone up and the non-bank funders have increased quite a bit.
But you haven't seen their rates go up proportionally.
Not as much, no.
Not yet.
Don't say that too loud.
Yeah.
Why demand?
Questions already?
Oh, Kim, just your, and anybody actually, your perspective on capping your earnout. What's your point of view on that?
On if we like it to be capped or uncapped,
Correct.
I'd like it to be capped.
Never.
Are you still able to
Never cap it.
Yeah, are you able to still get the deals done?
Yeah, I mean, again, earnouts, no, you can give your opinion. I don't think either side loves them because they're impossible to think of everything. You go into it with the best of intentions. Hey, if you get to this level, we'll pay you. Maybe it's uncapped. That's great if earnings are off the charts. But there's always something, you just can't anticipate every twist and turn or circumstance. And so capping it at least caps what the exposure can be, because there's been plenty of times where part of the story plays out and the earnout is earned, but the way that you draw it up on paper, 30 days before closing isn't completely how reality played out. And so you kind of get in a position where you're like, well, shoot, this didn't exactly work out the way we thought, and we owe a big earnout. And you're trying to figure out, we're still partners with you. You own 20% of the business. We don't want to get crossways with you, but we have to come to the table and figure out a good solution here.
I've never done an uncapped earnout.
Yeah,
I don't know how you would get comfortable with the
exposure.
Yeah.
I'll just say, in all my years of doing deals, we've done earnouts twice. And the reason we did them was the second half was going to be better than the first half. And our clients said to us, why do we need to close in June? Our second half is going to be fantastic.
And then you said time is not your friend.
And I said, time isn't your friend. So we've done earnouts twice, and it's worked out really well for our clients.
So if I can ask one other earnout question, to your point, I think, Cam, was what's kind of the approach you take? Because I assume as soon as you drop down farther down into the P&L, it gets really complicated. So is there just like a couple points there that are good starting points for people to think about earnouts?
So this is where Sima and I would arm wrestle until closing. So we want it to be as low down the P&L as possible. The seller wants it to be as high up on the P&L. And their point is very valid because they could say, well, you're going to hire, our strategy, take a step back, our strategy is to build out a team. We got to hire a CFO. I have a lot of business cards to share with you all. We have to hire a CFO, we have to hire a head of sales. That brings EBITDA down. It's an investment in the P&L. Usually happens the first couple of years. And so we're doing the right things for the business to grow the top line, but it might not show up in EBITDA for 2 years. And so if the earnout's based on EBITDA, which is how we look at the business to value it, the seller is going to say, well, I wouldn't have made that higher. Now you guys are screwing me, for lack of a better word, out of my earnout. And we're saying, well, geez, we're just trying to build a management team to take this company from here to 2x. So we want it to be as low because that's how we value the business. It's created the same. And so if we do it based on revenue, then maybe the seller, if we were a pessimist, maybe the seller, we'd say, well, maybe the seller's just going to go out and find some revenue at 10% margin to goose up their top line, and it's really not good business to take on. We wouldn't have done that, if we were earnout wasn't there. So you can lose alignment, and so what you normally end up trying to do is to figure out a way you meet in the middle.
And like how you meet in the middle is whatever formula was used to get trailing 12 months EBITDA multiple, you use the same formula going forward and no adjustments.
Right.
Like you paid $75,000 for a recruiter to get your CFO, that doesn't get a minus against my earnout.
I won't negotiate an earnout on the table here. You do want to be as granular as you can.
Yeah,
right.
you wanna be
So
granular.
because otherwise that's something where you get to the 12th month and you're like, well, we didn't think about this.
Right.
And then no one's happy. So
So Emma, do you find that those private founders that you're focusing on, is earnout a common tool in your bag or not so much?
Well,
Is it
so
unique?
Can
for
you
our
use the mic?
Sure, yeah. For our platform investments, we're typically, because we generally have a very large rollover and our minimum equity check is probably more like 30 million. The businesses tend to be fairly large and an earnout isn't as common in these larger platforms. But because a lot of our businesses are taking on capital because they want to grow and take on a different risk profile and do M&A, we end up having a lot of add-ons for our portfolio, at which point the earnouts become a lot more common. We've seen a lot of different flavors. I'm just thinking through some recent examples. Sometimes landing on a gross margin is actually a nice way to bridge this gap as well. And so we do see that quite a bit. And again, it's a little bit more on the size, smaller side for the add-ons than it is for the platforms from our perspective.
Well, we have a question.
Yeah, so just a quick question. Aside from earnouts, how much, in terms of rollover equity, do you see that playing a more important role going forward, or do you consider that rollover equity plus a combination of earnouts to be how you would strike a deal going forward?
It probably depends on the buyer. For us, since we're buying from a founder or entrepreneur, we're the first institutional capital, having that alignment with them is critical. So our strategy has always been to have a pretty meaningful amount of rollover. 20-25% is pretty common because they're incented and completely aligned with us. If we triple our money, they triple their money. And so making these decisions about should we hire a CFO, they're making that investment as well. If they don't have a rollover or it's 1%, then they're going to be maybe more focused on an earnout or just less focused on growing the business. And so we find having that rollover, regardless of the current M&A environment, our philosophy has always been to have a pretty meaningful rollover now.
And for our clients, the average rollover is 10%. Now, 2 years ago, we sold a business where there were 3 owners, and the head of sales, very aggressive guy, he was going to roll over 20. The guy who owned only 10%, he was rolling over 5 because he wasn't getting that big a paycheck at the closing. But on average, it's 10% for our clients.
If I think about the mix of our current deals, and we don't have a requirement for a rollover, it just tends that the value proposition resonates well, and they usually have historically, of the 6, been a younger founder that wants to stay on longer. It's been more like 40-45% rollover, but as low as 15.
That's good to know. Any other questions? Okay. Oh, got it.
You mentioned inventory's up earlier, Cam. Whoop. Are you guys, is there a change in perspective on inventory levels? In the past, you buy a company, inventory's been, working capital in total has been mismanaged. You see the opportunity come in, monetize the balance sheet, take it out, but are you guys looking at that differently now with what we saw last year?
Yeah, it's very situationally dependent. A couple of years ago, like any company, whether it's PE owned or not, you couldn't sell what you didn't have. Lead times were at unprecedented levels, so we really encourage all of our companies to buy ahead, buy as much as you can because you can't sell what you don't have. Now, I think that lead times have come back down where you don't have to worry about, I'm not going to be able to get this part or this material for 12 months. I can get it in 4 weeks or 8 weeks. It's back to managing working capital appropriately. And so we just monitor, what are our lead times and what's our on-time delivery. And if that starts to become an issue, we have to just understand why. My comment about inventories being high is from a little different lens. A lot of our companies, especially the manufacturers, their customers are big OEMs, and they were doing the same thing as us 2 years ago. Caterpillar, they didn't want to be in a position where they couldn't sell something because they didn't have it, and so they were buying all of their specialty coatings for their tractors from their suppliers. And so they'd be calling us and saying, "I need this yesterday." And we'd say, "Okay, great, we'll get it to you," but it's there's a 15% price increase from the last time you ordered it 6 weeks ago. And so now Caterpillar, in this example, their end user demand, who they're selling to, has gone down. and they're sitting on a pile of inventory because no one could predict when the supply chain would start to correct itself. And so they've been holding on to inventory. So everybody in the supply chain is trying to find that right balance. But ultimately, what's getting pulled through is slowed down. I mean, things aren't growing as quickly as they were 2 years ago. And so when that happens, all the slack starts to build up in the line. And whether you're a distributor or a manufacturer, there's just more inventory out there now than there was 12 months ago.
Good questions from the audience. Going to shift a little bit away from Cam and Sima here. Maybe there's some dynamics going the other direction. Emma and Cam, could you explain maybe a little bit more about your business models, family office versus private equity? And what's the ideal seller look like for you?
So I think I've covered a little bit of the ideal seller, but just to reiterate, for us, it's a founder or a family that is looking at, they have a great business, but they're looking at taking some chips off the table and changing the risk profile to continue to accelerate growth. From a family office to private equity distinguishment perspective, our primary, I describe it as this fiduciary responsibility, because having had worked at a private equity firm that had institutional partners as our limited partner, I view the responsibility there as typically to generate return, period, full stop. The fiduciary responsibility that we've established through our arrangement with the Carlson family is to generate returns, for sure, but it's also to have a different perspective around taking care of the people and the employees and the communities, given the Carlson family's great history of doing so in the Twin Cities and their interest in doing so in communities that they invest in through our platform across the country. And so we've established a relationship with the Carlson Family Foundation where they're also able to philanthropically invest alongside us into those communities and the employees. And I view that angle, and frankly for me it was one of the reasons why I left the traditional private equity model, is that it felt like a holistic solution, that if I put myself in my great grandfather's shoes and thinking about the legacy of our business, what would I like that to look like? It was this kind of holistic solution as it relates to generating returns, driving great business growth, and taking care of the employees and communities. And then additionally, we do not have the same limitations with the investor group because of that dynamic, so we can hold for, frankly, an indefinite period of time, which is really a family business mentality, a family business continuation vehicle that the Carlson family has established with this private equity angle. So I think it's just a different approach than the traditional PE model, and those are the distinguishing factors that we typically clue in on.
Yeah, unfortunately, I can't sit up here and say that Carlson Group's a terrible alternative, so you should come to Tonka Bay. Emma and her team are fantastic people. They're great investors. They've got a really compelling model. Maybe what's the difference, the distinction is we do raise pools of capital that have investors contributing capital that have a long-term vision. They understand this is not a liquid investment. They can't buy and sell the stock. They're 10 to 12-year funds historically in private equity. So there is a long-term investment horizon, but there is a endpoint to that. So our average investment period is 6 to 7 years, which is on the long end of private equity in general. And so what makes a good seller to us is a founder who wants to find a good cultural fit, and their time frame aligns with ours. And so if they're looking for something, I'm ready to sell now and I want to be fully retired in 6 to 7 years, that can be a really good fit for us. Fortunately for sellers, there's a lot of different flavors now of investors, whether it's private equity, whether it's mezz funds, whether it's family offices. So, founders are in a terrific position to kind of find a good cultural fit for them, because every group of investors has a different kind of approach and culture, and there's a lot of great ones out there. There's a lot of great ones here in the Twin Cities. So they can just find a group of culture that they fit in well with, and their time horizons are aligned with.
So just following up on your comment, Cam, about the cultural fit. So when we bring a company to market, we probably reach out to 100 different potential buyers. I'd say a lot of PE funds, some family offices, and some strategic acquirers. And in the end, we tell our client, you get to choose who you marry. And some of them like the family office approach because it's longer term. They'll hold for 10 or 20 years, slow and steady. Whereas the private equity will typically resell their company in 5 to 7 years. And it's a very fast pace where they're making lots of add-on acquisitions. Some owners like the fast pace, some prefer the slow and steady. And mostly what I'm seeing is they are not doing deals with strategic acquirers because most of our clients want to take care of their employees, and they know that the strategic's going to get rid of the CEO, the CFO, the head of HR. So they tend to be the least favored buyer of our clients.
That's well said, and I couldn't get any sparks between the two of you. That's you play nice together. That's great. I'm gonna talk to Emma a little bit because we had Beth Lilly from the Polet companies last year, and she talked a lot about the partnership of family offices and the sharing of deals and the collaboration. And at that point, it seemed like it was on the uptick. Is it still on the uptick?
Yeah, it's been really interesting to leave the traditional private equity model and come into the family office world because there's all of a sudden there's just this open book sharing of deals. Whereas otherwise, I mean, even if I was at a traditional private equity firm, we're all, especially locally, everybody's friendly, but I would never share my deal book with Pam. But the family offices, they do. And it's great because I guess if you meet one family office, you've met one family office. They're very different. Everyone aligned, everyone's families are different, everyone's strategies are different, but there is a little bit of a herd mentality, especially as it relates to the attractiveness of direct investment. So investing either through your family office and buying one new operating company and managing it as your family, or the other extreme, like the Carlsons did, setting up a direct investing vehicle and hiring a team of people to do that on your behalf. And not as many, we found, have the latter, which is the way we're set up. So it's been really advantageous to us to be able to work with groups, and Polets are probably in between in terms of the number of people that they have focused on direct investing relative to maybe other single family offices that are smaller without that breadth of bandwidth to do the deals. So we found that to be really favorable for us because we're able to bring in other families into our investments to help perhaps fill out the capital structure, and those families who maybe don't have the same setup to generate the type of deal flow that we're attempting to in our platform. But there's definitely a interest, willingness, appetite to invest together as families. There's also this trust factor that's established more easily for whatever reason between family to family partnerships. And so it's a really interesting dynamic that's only continuing. It probably makes Sima's job a lot more difficult though to put the deal together.
But what's nice when the family offices partner is they each bring something unique and they each bring their own set of contacts and are able to open up different doors.
That's excellent. I'm going to give Sima a little chance, maybe a little commercial for investment banking. How do you know when you're interviewing an investment banker, what's a good investment banker look like? What qualities do they have? What can they bring to the table?
Number one criteria is experience. And I've been doing deals and my colleagues for close to 30 years, so we've seen a lot. And some of the big investment banks, they bring in the senior guys to sell the business owner. And then once the business owner signs the contract, the senior guys disappear and they put some 25-year-old newly minted MBA who doesn't know a damn thing. So we've had folks change investment banks. We've been the beneficiary of the big banks putting the 25-year-old on the deal.
I suspect people look at deal history, deal experience. How many did you get done? Your team. You're not just one person. You have a team around you. So
Right.
If I was on the other side of the fence, I would be looking at your whole team in experience levels.
Right. I have a great team. I have Joe Phillips, who was at 3M for many years building businesses. And then he went to iMation and sold off 18 companies and hired and fired investment bankers. So our clients relate to Joe. And then we have Adam Palmer, who's a vice president. We hired him. He was an intern in his second year at the Carlson School. And he did such a good job as an intern that we hired him when he graduated. And he's been with us for 10 years. So they're a lot smarter than me. And, yeah.
I'm going to shift the direction a little bit. So there's been a lot of talk about due diligence and mostly focused on the buyer side. I think there's a trend, if you will, to do more seller due diligence to prepare for a sale, especially if the market's not moving quite as fast. Obviously, we would like to have that discussion sooner than later with a client, so we could help them 2 years out. But realistically, they hear of a deal from their neighbor or their business partners in other industries, and they think they got to sell today. Can you talk a little bit about how maybe the sell side due diligence market looks?
Yeah, it's a good question. When I started with E&Y here doing transaction advisory work, it was 11 years ago. And the buy side QB was pretty standard. With the sell side QB, we had to really pitch to private equity clients because they're spending money before they've gone to market. And you fast forward to today, and we do it no questions asked for every company that we're selling because yes, it's an investment, but it prepares you for the sale process and getting through a sale process. And you know better than anyone, it's all about keeping the momentum up, keeping buyers interested, and the best way to derail that is to have bad month of performance or there's a pothole that you hit, and it's the buy side team says, well, we found this. And if you had known that 3 months ago, again, like we talked about earlier, no company's perfect. Everybody has their scars. But if you find it when you still have the competitive dynamics and leverage, then buyers can decide how important it is to them, and they can react to it or move past it. And so it's an investment that you make, but it paves the road for the rest of the process. And so for us, it's never a question of if, it's when do we get started. And I think it is moving up a little bit because the investment bankers want to have it. I think there used to be a time where you get the sell side QV and they give you one number, and the investment bankers have a different number, and then the buyer's like, okay, well, we'll split the difference here. Somebody's better, someone's kind of closer than the other. Now, a lot of times we see is the bankers just wait to get the sell side QV, and you drop it in, and it's something you can roll forward, and it's been a great tool for both sides, the buyer and the seller, to have somebody already kind of prep you for what the process is. And the other nice advantage it has for you all in the room, someone's going to do this work anyway. You're going to get the 200 item request list. And so if you can do it sooner, when you have a little bit of time before the process is in kind of hot and heavy crazy mode, then you have a data room. I'm sure your team's got the stuff all built out. And the investment bank has helped shepherding through all this. And so they've got the data all organized. So then when you have the buy side QB group come in, they give you the request list, and it's all there. And so, to your question earlier, Jay, what makes a good investment banker? They're a resource in the process, right? So you have the depth of your team. And so when the buyer comes and asks questions, you've already prepped them for it. Your team has got the numbers in place. They can be a tremendous resource for the CFO who still has a day job. They're still trying to be the CFO of a company while taking on a second job, which is trying to help sell the business. Because unfortunately, when you go through a sale process, 80% of the requests comes down to the CFOs out there. It's just kind of the nature of the beast. And so the sell side really helps just start to get ahead of some of that work and find any potential issues that could be in the financials.
I'll just say you're deep pocketed, and so it's no issue to hire an accounting firm to do a QFE for your portfolio company. But our clients, the business owners who watch every nickel that they're spending, they're like, why do I need to spend $80,000 on a QFE when the buyer's going to spend that money? So that's the dilemma.
It's funny, back in the day, we called them profit improvement studies.
That's what they are, though. They really are, because if you don't have that information, and you're going out there with a number, you're going to end up in a situation like Cam described, where you have a sell-side QB that's different than the banker QB, and then you're really going to be sorry because you'll have paid the banker for a process that you think is going to deliver a certain result, and it's not. So it's really, I can't think of the last deal platform that we invested in where there didn't exist. And frankly, the add-ons we've done where they haven't, I'm quite certain that the sellers haven't gotten the value that they thought they were going to get on exit.
I guess that was my point. If it adds value to have that work done, and the multiple is increased, it more than makes up for the fee you pay. It's a leap of faith, but we're seeing more and more of it, and we're seeing the results. And again, that's small business to lower middle market. I think Derek.
Going back to what I had asked earlier, you're seeing stock sales, asset sales, a blend, because tax laws impact some of the owners extensively, so they fight really hard for the stock side or whatever. But what are you seeing out there now? I worked with a guy who used to take, an owner of a multi-million-dollar business, he'd go and take his key to all the vending machines and put the coins in his little bag. So talk to your point about being cheap.
I think the question is deal structure and asset deals, stock deals. What is happening?
We're seeing a mix. Sometimes you just can't get off of that mentality, and it's easier just to suck it up and do the stock deal as the buyer, especially because the dollars can be significant to the seller. So it's been a mix. We of course prefer an asset deal, but it's not as easy to come by.
Yeah, I would agree. It's a mix. It's very situational. It depends on what structure they have. If it's an S corp or C corp. The interesting thing is, since the C corp rate came down a number of years ago, that's not as bad of a structure as it used to be. There's some benefits to it. We all always prefer an asset deal on the buy side. There's a lot of great partnership structures you can do, but it's a mixed bag. Sellers, founders are very tax motivated, and so that's always a consideration where we're just trying to find the best path that's mutually acceptable to all parties.
Yeah, the buyers always want an asset deal because they don't want to assume any liabilities, and the sellers don't want to have a huge tax bill. And we've seen buyers make up the difference of the higher tax bill for our clients to get the deal done. But an earlier panel, they talked about F-reorg.
Right.
Those are very popular.
Good question. I was going to say I don't think there's many more attorneys left in the room, so I feel like I can answer.
I don't want to talk about F-reorgs.
No. What are you seeing relative to deal documentation? Is there any movement in terms or reps and warranties?
The rep and warranty market has been really interesting because, I don't know, it was introduced maybe 10 years ago as really an earlier product, and now it's proliferated and it's coming down market to deal sizes that I would never have thought to see a policy be put in place for at a reasonable price. And right now, because the deal market is slower, you're able to get coverage in these policies at rates, for really, really attractive prices, which reduces or should reduce the negotiations that happen around the reps and warranties of the deal. So that's the biggest difference that I've seen over the past few years on rep and warranty. When the deal market was super hot in 22, it was hard to even get a policy in place. but now it's a lot easier, and it's making the documentation process a lot easier, at least from my perspective.
Yeah, probably down to $30 or $40 million of enterprise value. I think you can do in $25 million of enterprise value, you can get an RWI policy, which usually for both parties is like the greatest thing since sliced bread. And 5 or 6 years ago, it was probably 50 million, 75, 100 million, where it wouldn't really make economical sense to pay the premiums that you would have to pay to secure the policy. So that's come down a lot. I would say in the last 12 months, like everything else, just it seems like the terms have moderated a little bit. It was very seller friendly 12 to 18 months ago. And when you were a buyer, again, you had to differentiate with speed and terms. It's always, you name the price, I'll name the terms. And so I think that has moderated a little bit now, and there's more normalized exclusivity periods and terms of getting the deal done.
So I'll just add to that so on the purchase agreement, you make all these reps and warranties. You're a company in good standing, you don't have any lawsuits, you paid all your taxes, and in uncertain times, the legal counsel for the buyers makes sure these reps are really tight. But when you have rep and warranty insurance, the reps don't need to be as tight because the insurer will cover you if something you said in the rep wasn't true.
Excellent. Just checking for questions. I believe maybe a few of you have questions that you'd like to ask, but I'd like to kind of summarize it up and then we'll do more questions. But thinking of the end of 23, 24, what's your outlook? And I'll let you maybe preference that by what could be some things that derail your outlook. But I kind of like to sum it up with that one question, forward-looking question. So who would like to go first on that one?
I can go first. I think to the second part, what could derail? I think everybody's watching the Fed at this point and what's going to happen in the interest rate environment and the recessionary headwinds that we may or may not already be seeing. But overall, I think that at least for where we focus from a founder-seller perspective, there's been a lot that's happened over the past few years that's really exhausted a founder in terms of the mental load that they carry to own and grow and invest in their business, both through the COVID challenges and then the supply chain whipsaw that they were experiencing over the past year. That I think there are a lot of founders that are just ready to share that burden and bring on an investment partner. And for that reason, I'm optimistic about the next, the next 12 months, because I do think that there hasn't been an opportunity really the dust hasn't settled, and it's kind of settling, even though there are these headwinds, and I think it's going to result in sellers who are ready to transact.
Yeah, I think that's a great point. Since we're both buying from founders, everything that's happened in the last couple of years, and the fact that valuations have moderated slightly, founders are still getting a year older. And so they've gotten to a point where it's like, boy, okay, maybe I'll take 8 times for this company. And maybe I could have sold it for 9 times last year, but I'm getting a year older. They have the existential question of, is this worth it? Going through COVID, all that. So I think that's good for us. What could derail? It's hard to think about, like, everything that's happened in the last 18 months since the war in Ukraine started. Like, that didn't derail things. You have like is China going to invade Taiwan? That's always out there. There's all these kind of geopolitical things that have been out there for a long time. Quite frankly, I'm surprised that like Silicon Valley didn't derail things more. That was like a week of headlines, and then it's still there, but it's not something that at least we're talking about as a kind of macro risk. So it seems like, if I was just to predict, it seems like we're going to just keep plugging along at this kind of same pace. I think because we track the PMI, the Purchasing Managers Index, very closely as an investor in manufacturing companies. A year ago, it was like 56, 57. And for context, if it's above 50, that means people, purchasing departments are expecting growth. They're buying more. If it's below 50, they're buying less. So it's contracting. A year ago, it was high 50s, which is like off the charts. And right now, I think it's like 45, 46. And so people are just making less because people are buying less. So I think that's going to continue to be the trend. Inflation is a big problem because costs are not transitory, labor rates are not transitory. If you gave somebody a $4 raise on the plant floor last year, you're not going to bring that back this year. That usually doesn't work well, especially when the labor force is permanently shrinking. So inflation and labor are the two more micro issues that they're not going to, I don't think they're going to derail things, but they're going to be the headwinds that we're all facing.
So following up on your comment, Cam, about inflation, if the Fed continues to increase rates, I mean, I was so relieved 2 weeks ago when they didn't hike them up, but they're talking about 2 potential rate hikes for the rest of the year. That's going to slow things down, because when I recently complained to a PE fund that he was only offering a 7 multiple on my client's business and not an 8, he's like, well, I'm paying the bank 7% this year. I paid him 3% last year. I can't spend as much on your client's business. And you also talked about the gray tsunami, all these 50, 60, 70-year-olds wanting to retire. If they don't get their number, they will hold off on selling. And that's a concern. And every business owner has their number. And we start our process with potential clients by saying, what's your number? Because if they think their business is worth 2 times what we think, we're not going to take them on because it won't get to the finish line.
Great points, and I will ask one other question because it was brought up in our first session. When you are listening to buyers and sellers, what about the pending election year coming up? Is it even on the radar at this point? Lori, that's
Yeah,
for
I'm just
you.
going to pass comment on anything political. No, I mean, I think it's always such a it's always something that is out there, but I don't think anyone can accurately predict what the impact is going to be, because I don't think anyone's predicted what's happened politically over the last couple of terms. So
Yeah.
it's
fodder for discussion, but that's about it.
the global geopolitical environment is getting a heck of a lot more airtime in our shop than the election.
I think what's key is the tax rate. So when tax rates look like they're going to go up, we get more business owners reaching out to us and say, get the deal done sooner rather than later.
That's a good point. One question. We have time. We have time for more questions.
Yeah, we've got 10 minutes.
Yeah.
From a global perspective, with the Fed raising rates, it's created opportunities offshore versus onshore because of the dollar index strengthening from, it was in the low 90s to about 114, so about a 20% increase. It's settled back to about 102 to 103, but I've got colleagues in Europe and other parts of the world saying the investment opportunities with the dollar here are phenomenal. Why aren't we seeing more dollar deal flow in the UK and Europe and places like that? Any thoughts on that?
I think following all the supply chain disruption over the last couple of months, or couple of years, bringing things back onshore. Onshoring has been happening for a number of years, but I think with as disrupted as things got, that made the USA is becoming a more popular way to approach things. COVID had an impact that I don't think we'll fully appreciate for another decade, but I think the near-term impact is bring things closer to home. And the dollar has more value right now, it's absolutely true. But I think people, at least we're investing in U.S. companies, that's our mandate. And so we're already focused on that area, but I think even more broadly than just us, I think people like to keep their product close to home because it's a heck of a lot easier to drive it up from Texas than just put it on a boat and get it here.
Yeah, and adding to what Cam said, we represent a lot of manufacturing companies, and what COVID taught us is you can't do all your manufacturing in China. And so we're seeing a lot of M&A activity right here in the U.S. because acquirers want to have more domestic manufacturing capabilities.
I agree. I would just add that there is a heightened sensitivity around diversification of the supply. So to the extent that we're able to take and mix production, some domestic and some international, and at various international locations, either owned or contracted, that's on our radar as well. And so that does play a little bit, but overall the reshoring trend is much larger tailwind.
Thank you.
Anybody else? George, you're always good for one question.
Well, I've already given you two earlier.
Thanks.
One more, bouncing off your theme about the moving target with owners. Are you seeing owners? Oh, excuse me. Thank you. I was trying to. The moving target with the multiples. Owners have a number. You've mentioned that. That's shocking. We had a close setup for January. They got a multi-million-dollar order and the number changed. Imagine that. They could have closed and had a sweet deal and they still were looking for another number. Are you seeing people holding on saying, I'm going to get this number no matter what, hell or high water?
Go ahead.
That's where the investment banker really makes a difference to line expectations on the front end for that.
We can only succeed at Aethlon if we take good care of our clients. And if we see they're going to bring in a $20 million contract, we will advise them to hold off on the sale and wait.
Yeah, Eric, we actually have a client right now in a holding pattern because they have a big contract negotiation that means a lot of money, and for that reason. Well, if there's wait, George got one. There he. I knew he was lurking. This is Brad's fitness program.
Well, Jay, you invited me, so what can I do? So, Simon, Emma, and Cam, thank you so much. Put yourself a year from now. You're at the same program for the 11th annual M&A conference, okay? And then look backwards, okay? I want to ask you the question: what prediction about the next year are you most confident about? That you'd be able, we'll come back and we'll say, well, this is what they were most confident about. And did it come true?
I think things will be, so 12 months from now, I'm looking out 12 months from now. So I need my Excel to figure this out, what time frame we're talking about.
Are you talking about the next year?
Yeah, next.
I think things will be better. I think, I don't think the second half of 2023 will be tremendously different than kind of what we're at right now, but I think there's slack in the line that is going to work itself out. If COVID was 2020, 2021, that slowed things down, it heated up, now it's cooling. The pendulum is going to kind of come back to normal, I think, in 2024. Because right now, people are still kind of working through excess inventory, and that just drives everything. And consumers are not as confident right now. And ultimately, we're a consumer-based economy. And so even in the Caterpillar example, Caterpillar is doing something that a consumer is going to buy. And so consumers aren't real confident right now. So I think as that starts to normalize, that'll pull the slack through. I think performance will improve from kind of this slower period we're at right now.
I think that we're really going to be talking about the impact of the election a year from now. And that's going to be the big headline in terms of concern and debate over, how that's going to impact their sellers and our investments.
So the one thing I am certain about is that gray tsunami, all the 50, 60, and 70-year-olds who want to retire and sell their business. So there will be businesses for sale. What I'm not sure about is the economy. I mean, Deutsche Bank said 100% chance of a recession, Q4 of 23. Goldman Sachs says 25% of a recession. So that's uncertain. Yeah, that's uncertain.
Knowing Cam is an optimistic person, I would probably discount that and say I think it's more of the same.
You an
One of us will be right.
optimistic
A year from now, back on this panel. I'd like to thank all of you for taking time out of your day to be here, and I'd like to thank my panelists for taking the time working with me and going off script once or twice, not too bad, but thank you for your time and participation. Again, thank you for my support group behind the whole scene, and I'd like Brad to wrap it up. If you could wrap up, Brad, just say a couple things about maybe what we've got, a couple more events coming here that you could point out. And again, looking forward to next year.
Terrific. Again, let's thank our moderators, our panelists. Really fantastic information. And again, thank all of you for coming today. Also, CPE credits, if you came here for them, remember you have to sign out and register for them. Or you could call me later, like some of you like to do, and say about those CPE credits. What Jay was referring to is we have our golf tournament coming up next month. If you haven't registered a foursome, please do. We're at about 75% right now, so that one always sells out, so please register for that. Our friends at Horton Group have given us a limited number of seats for an event over at the University of Minnesota. PJ Fleck is going to be speaking, and that's on July 18th. We've got an event or two that will be occurring in August, and then our full lineup will be in front of you probably in the next 2 weeks for the fall. We've got a lot of great stuff coming up. And again, thank you all for being here today.
Thank you.